Welcome to the week ahead. This isn't a hype show, it's not a prediction contest, and it's definitely not a place where we try to trade every headline. Each week, we're going to step back from the noise and focus on what actually matters, the signals shaping capital, policy, and markets over the next decade, not just the next day. Think of this as your reset before the week begins. Now, let me start with something that has absolutely nothing to do with markets. This weekend, I ran a half marathon. Now, I finished in 1 hour and 35 minutes, and I'll tell you right now, it was tough. It was hard. Not race day specifically. I mean, it was hard, but the hard part was really everything before it. Running in the dark, cold mornings, wind, rain, even snow. I can't believe I'm saying that, but we all know that Charlotte got snow a couple months ago. Those were the days that I didn't want to go. Days it would have been easy to skip, but race day wasn't built that morning. It was built months before. And honestly, that's exactly how you should be thinking about markets right now. Because if you just look at the headlines this week, it feels uncomfortable. Again, I say that almost every week now. Markets pulling back, volatility picking up, a lot of noise, but that's not the story. So today, I want to walk you through the 3 signals that actually matter and, more importantly, what they mean for you. Now, there's a growing belief right now that rates may actually move higher again by 2026. That's a big shift. Most investors are still thinking in the old playbook, right? Rate cuts, easy money, support. That's not what's happening. The Fed, they're focused on long-term stability, not short-term market comfort. And here's the part that most people miss. This isn't bad news. It just changes the rules. We're in a world where, one, money isn't free, inflation doesn't disappear overnight, and discipline matters more than ever. So what does this mean for us as investors? It means we don't chase. We don't stretch for a risk, and we focus on getting paid through income, quality, and durability, not predictions, process. Now, signal 2, you've seen the headlines, tech stocks pulling back, volatility in big names. That's really making people nervous, but underneath that, something important is happening. AI is shifting from this might change the world someday to the thinking of this is improving margins right now. And companies are using it to cut costs, improve efficiency, really drive profits. And that's a very different phase. It's quieter, less exciting, but it's much more important. So again, what does this mean for us as investors? Well, we stay invested, but we stay selective. We're not paying high prices for big companies. We're looking for companies that can actually turn technology into cash flow. That's where long-term returns come from. Now, the last signal, this one matters more than people realize. It's not just a market story, it's really a supply story. We're seeing real disruptions in global materials, things like aluminum supply being taken offline. That's not sentiment, that's physical reality. And here's why this matters. You can't fix supply problems with interest rates. That's a shocker, I know, to everybody. So even if the Fed does everything right, in quotation marks, some inflation pressures don't just go away. So again, what we're going to always ask the question, what does this mean for us as investors? It means volatility is not a mistake. It's a reflection of the real world. And in environments like this, the advantage goes to investors who are, number 1, prepared, number 2, diversified, and thirdly, not overextended. Now, one quick note before we wrap up. Later this week, we're launching something new. It's called Inside the Portfolios with Hobart Wealth. And that's where we're going to go deeper. What do we own? Why do we own it? What's working and what isn't? This podcast, it's about helping you understand what's happening. But that new series is really about showing you exactly what we're doing about it. So if you've ever wanted to look under the hood a little bit more, we're going to have that for you. Now, the big number this week is the jobs report on Friday. Last month was rough. Job losses came in stronger than expected. This week, we're looking for signs of stability, not perfection, but just stability. Because right now, the market's really asking one simple question. Is the economy slowing or is it starting to break? And that's what this report on Friday helps answer. Now, let me bring us back to that race. About halfway through, or as this is probably closer, about 3/4 of the way through, the course turned into a neighborhood with rolling hills. And that's where it got real. Legs were heavy. Breathing becomes even more strained than it was before. And there were moments, if I'm being honest, where slowing down felt like the right move. But I had a pace group, and I had made a decision before the race started. I wasn't going to negotiate with myself when it got hard. I was going to stick to the plan. And really, that's what got me to the finish line. That's really the environment that we're in right now. Not easy, not smooth, but here's the takeaway: completely manageable with the right process. So again, takeaway for the week: don't let short-term discomfort change a long-term plan. Because just like that race, the results you want later, they're built by the discipline that you stick to now. And I can't reiterate that enough. Stay steady, stay invested, stay focused. We'll keep doing the thinking for you. And I'll see you next week. Prepared, not surprised.